Example 5. Mr. A carries on a business as a sole proprietor. Mr. A sells computers. Mr. A decides that he will take one of the computers out of trading stock and that he will start using it as part of his property, plant, and equipment in the business. Okay, trading stock becomes a capital asset. Trading stock is out of the net, capital asset is in the net. So we are treated as the deemed sale and market value. Okay, so the computer, which was trading stock, was originally cost 20,000 rands, and I say it formed part of opening stock at the beginning of the year, and it's transferred when it has a market value of 30,000 rands. Okay, so opening stock, guys, I just want you to see, again, this is something that's not a focus for us in this lecture, but just as a quick reminder, 20,000 rands, opening stock's a deduction. Then, when you move it out, you are treated as if you sold it. So moved to capital asset. Okay, now this is per section 22.8 tells us that, but also in paragraph 12. So you treat it as if you sold it for 30,000 rands. Now, one thing that the university indicates, you should indicate when there's a sale of trading stock, is you should show the capital gain implications of it. Now guys, I am just showing it to you once here. You'll see that it is not ever shown really in questions, ever, in solutions. So it does not appear to be something that is really applied rigorously. Proceeds is the selling price, 30,000 rands, minus, and this is an important principle, that's my main reason why I want to show it. Remember, paragraph 35.3 and paragraph 23, they both have the same thing. The one in 35.3 is proceeds, 23 is base cost. Both of them say you need to reduce the proceeds and the base cost by the amount which has been already included in tax in your gross income. So proceeds is 30,000 rands, but that 30,000 rands from the sale has already been included in gross income, so it becomes null. Base cost is the cost, 20,000 rands, but the amount which has already been deducted gets deducted, so it's null. So when you sell trading stock, there will always be a capital gain of null. Right, so that goes into my CGT column. Now guys, my recommendation is when you sell trading stock is to just write and say capital gain and is null. Even just write it out. That is a good way of addressing it. Okay, so that's in there, but my focus and your focus now, let's get back to the principle, is trading stock which is out of the net becomes a capital asset which is in the net. You had an opening stock deduction, that's not specific to CGT, that's trading stock rule, but when it moves out, you're treated as if you sold it at market value. There we go. You are then treated as if you purchased it at market value. Now what happens when you buy a capital asset? You can claim a capital allowance. They tell you it will be used for 4 months and has a useful life of 3 years. The market value is 30,000. So you are treated as if you bought it at market value, and then you can claim an allowance. Will be section 11E, which is your wear and tear section, 30,000 rands divided by 3 times 4 over 12. Right, there we go. Then we have example number 6. Miss T is a South African resident and she decides to immigrate to Peru, so she becomes a non-resident. Okay, so resident, which is in the net, becomes a non-resident, which is out of the net. Again, as a reminder, a resident, all assets are in the net. Non-resident, only immovable property and assets attributable to a permanent establishment. So what does this mean for us? This means when this happens, so there's a deemed sale at market value, except for immovable property in South Africa and permanent establishment in South Africa. And then as a non-resident, there's a deemed purchase at market value. And again, except for these two assets. Why? Because they are in the net as a resident and they are in the net as a non-resident. So there's no movement. Remember, we are only concerned with assets which move in and out of the net. So let's just look at the detail of this question. That's the theory we're going to be looking at. On the 1st of July of the current year, Ms. T left South Africa and became a non-resident. Here's a list of her assets on the date of immigration. She did not sell any of the assets before she left for Peru. So she's got a home in Johannesburg, note number 1. So home in Johannesburg in 2003 for 1.8 million rands. She used it up to the day of immigration as a primary residence. Okay, so here, for all of these places as a resident, I'm going to do the following. House in Johannesburg. Let's do the implications of it. This is immovable property in South Africa. So there's no deemed disposal. Why? Because that is immovable property in South Africa. Nice. Next one, motor car. Ms. T purchased a BMW for 200,000 in 2006. She used it as a personal motor vehicle. Okay, what happens to a BMW? She is treated as if she sold it at market value. But what is this? BMW is a personal use asset, which is out of the net already. It's still out of the net, but it's a personal use asset. That's all you have to say. Personal use, and personal use asset means no CGT. Okay, then a boat, number 3. Ms. T loves boating. She purchased a 12-meter long boat in 2009 for 400,000. Nice, a boat. It's also a personal use asset, but boats longer than 10 meters cannot be personal use. So what does it mean? Thus, we need to calculate a capital gain. And what will the capital gain be? Proceeds is the market value. The proceeds for the boat is 600,000 rands. And our base cost is 400,000 rands. How much it was purchased for? Right, so there is a 200,000 rands capital gain. Then a computer, note number 4. Ms. T carries on a business as a graphic designer through a sole proprietor. Ms. T uses a computer for her graphic designing. She had originally purchased a computer in 2012 for 50,000. The base cost of the computer is 30, and this is considered a permanent establishment in South Africa. Right, so the computer, there is no deemed disposal. Why? Because it's an asset of a permanent establishment in South Africa. Okay, and then we have the Krugerrands. She inherited Krugerrands when her mother passed away in 2009. At that time, the Krugerrands had a base cost of 38,000 rands. And if you inherit something from someone, that market value on the date of death is also the base cost. That's what they tell us there. Right, Krugerrands, guys, not a personal use asset, because it's a coin made mainly of gold. So we have to calculate a capital gain. The proceeds in this case will be 50,000 and the market value will be 38,000. So there will be a 12,000 rands capital gain. Alright, now I just want to show you. In the question I broke it down A and B. And A, I ask you what assets are subject to CGT. as a resident and what address, and B, what is as a non-resident. So this is just to show you if they are moving. So I just showed you now, let's just go back. Which of these assets did we calculate CGT on? The Krugerrands and the boat. Okay. Now, pay attention. In A, this is when the person is a resident. Which assets are subject to CGT? And in B, as a non-resident, which assets are subject to CGT? Right, so as a resident, the home in Johannesburg is, and as a non-resident, it's also. So there's no movement, so there's no capital gain. The motor car is not in the net because it's personal use asset, still not in the net, no movement. The boat is in the net as a non-resident, but it is not in the net as a non-resident. That is why there's a capital gain on it. The computer is in the net, stays in the net, no capital gain. The Krugerrand is in the net, doesn't stay in the net, so there's movement. That is why those assets, again, which one? Did we just say? The boat, right? And the Krugerrands. Those are the ones that moved, and those are the reasons why we have CGT on those assets. Right, what are the tax consequences of immigration? Which is what we just calculated over the year. Now, just guys, important here, remember, another implication is, at this point in time, when on the timeline, her tax year ends, and the new tax year begins. So as a non-resident, she's deemed to purchase everything at market value. She's not the house, because that was not sold. The BMW, well, she can buy it, it's a personal use asset, there's no deduction. The boat, same thing, she buys it, but what happens if a non-resident buys a boat? Nothing for South Africans, there's no effect. The computer, no sale, there's no deemed disposal because it's still in South Africa, so nothing happens to the computer. She's not treated as if you purchase it again. The Krugerrands, she's treated as if you purchase it at market value. What happens when a non-resident purchases Krugerrands? Nothing for South African tax purposes. There's just a new base cost. Okay, so that is what happens in that question. Alright guys, so obviously, just to remind you, CGT column, you add up everything, 40,000 rands get deducted as an annual exclusion. That next total is called the aggregate capital gain. You have to write it out in an exam. Capital loss brought forward, null, gives you the net capital gain, and then you have your inclusion rate. I always want you to write out this last bit here, even if you didn't have a capital gain calculated. So if you have all your capital gains were null there, for example, then the exclusion will be 40,000, but it's an exclusion, not a deduction, so it stays null, 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 and I want you to write down the rate. Because what happens often in exams is that for some reason you missed capital gain. You'll still get a mark for the 40,000 and for the 40%. But if you have a null there, most students can just leave the rest part of it out. Understandable because you haven't had a CGT. But if you just put down the skeleton, you can score those marks. Example 7. Miss P is a resident of the USA. Miss P owns a property in South Africa that she has visited a few times over the last few years. She fell in love with South Africa during her visits, and she has decided that she wants to move to South Africa. Miss P immigrated to South Africa on the 1st of July, and here are her assets. Okay, so we have a non-resident becoming a resident. So at this point in time, there's a deemed disposal at market value, except for which assets? Immovable property in South Africa and permanent establishment in South Africa, because those assets are already in the net, because a non-resident is mostly out of the net and a resident is in the net. So those assets are already or just excluded. Okay, so they give us the assets. So I'm going to go through each of them. So let's just actually go to the required. So first of all, what assets would be subject to CGT when she is a non-resident, and which assets would be subject to CGT as a resident? So it's the same principle I followed in the previous question. I'm just going to remind you, as a Resident, all of your assets are. When it's a non-resident, only immovable property in South Africa and permanent establishment assets. So that makes it pretty simple. Okay, so if we look at it, first one is a home in Johannesburg. So I'm going to write it here. Home in Johannesburg. There's no deemed disposal. Why? Because it's immovable property in South Africa. Okay, perfect. Next one is a home in the USA. She's got a house in America. Right, 4 million rands. So, the house in the USA, there is a deemed disposal. Now, important. What happens when a non-resident sells a house in America? What happens for South African tax purposes? Nothing. It's not from a South African source. So there's nothing that happens. Okay, so remember, you're disposing it of as a non-resident. Next one is a boat. She has a old Toyota she purchased in 2004 for 200,000 rands. Sorry, did I say boat? Sorry, motor car. Motor car. Again, what happens if a non-resident sells a motor car? It's not South African source. This is also a personal use asset. Right, but not South African source. Let's go with that. Boat, number 4. It's a 12-meter boat that you use to drive around in small circles in a dam in Michigan. Right, the boat. What happens if a non-resident disposes of a boat in America? It's not a South African source. So no CGT. Okay, the computer. She carries on a business through a permanent establishment in South Africa. So that computer, there's no deemed disposal. It's immovable property in South Africa. Sorry, not immovable property, permanent establishment assets in South Africa. And then the Kruger Rands. She has Kruger Rands, right? Again, what are the South African tax implications? There's not a South African source. Right, but there's no CGT. So which of these assets was subject to CGT as a non-resident? The house in South Africa and the computer. All of the other assets have been deemed to have been disposed. Right, so this house in South Africa and USA is a deemed disposal. The motor car is also a deemed disposal. There's just no, it's just not South African source. So all of these are the same, guys. The not a South African source is still a deemed disposal. I'm just trying to indicate to you there's no tax implications in South Africa. But what is important is that you are deemed to buy these assets at market value. Okay, so now, why is that important? What are the effects of her immigration? Right, until she becomes a non-resident in part C. So that's the first thing I just want to show you. That's what we just did now. Can you see there's no implication? Alright. Then D. What would be if she sold the 2 houses 1 week after she had immigrated? Right, so she comes to South Africa, she's now a resident. Now she sells both the houses. She sells the house in Johannesburg for 2.8 million and the house in the USA for 4.5 million. Remember now, guys, she is now a resident. What assets are subject to CGT? All of them. So she will have to calculate CGT on them. And just over here, she used the home in the USA as a primary residence up to the day she became a resident of South Africa, and she never used the house in Johannesburg. Now basically what that means to you, remember, the primary residence exclusion is only for the period it was in the CGT net. The house in the USA, she said she used it as a primary residence up until the date that she leaves. Now, the house in America is outside of the net. So that personal residence is outside of the net up to that period of time. So there's no personal residence exclusion. You can only if you used it in South Africa. Okay, but now, what happens when she sells it? So remember now, she's now a resident, and now she sells the houses. So the house in Johannesburg, she sells it. Okay, so proceeds is simple because they tell you in the question what the proceeds are. 2.8 million rands. Okay, so now the base cost, and this is now interesting. The base cost, what is the base cost? We have to ask yourself, did she buy this at market value when she became a resident? For the house in Johannesburg, no, because it was already in South Africa. So I want you to see, this is the value, the market value when she immigrated, and the market value when she inherited this was R1,000,000. This R1,000,000 is the base cost. Why? Because she was not treated as if she sold it on immigration. Make sure you'll see in a second to compare it to the house in in the USA. So the base cost is R1,000,000. So it's 1.8 million rands capital gain. Again, guys, how long did she use this house for when it was in the net as a primary residence? This has been in the net when she was a non-resident as well, but she never used it as a primary residence, so there's no primary residence exclusion. Next house that she sold is the house in America. The proceeds, again, are given to us in the question as being 4.5 million. And this is now where your CTA skills come in. What is the base cost? I want to remind you, she was a non-resident that became a resident. She moved from out of the net to in the net. This house in the USA was one of those. It was treated as if it was sold at market value and then bought back at market value on this date. So what is the base cost? Remember, she's now a resident. She bought this house back at market value. So, although this house has a base cost of 800,000 originally when she was a non-resident, it's the market value when she immigrated that we use. Why? Because she was treated as if she bought it at market value. Why not the house in Johannesburg? Because that house in Johannesburg is excluded because it is in South Africa. But all other assets are not. So that house, the base cost was 4 million rands on the day of immigration. So she has a 500,000 rands. Now again, my question is, how long did she use this as a primary resident once she became a resident? She became a resident here. Remember, this is when it entered the CGT net. So that's the only time we can tax it. She did not use it at all as a primary residence. She used it as a primary residence when she was a non-resident, and we're not taxing that period, so she doesn't get any primary residence exclusion for it. All of these others, guys, the motor car and the boat and the Kruger rands, all of those will have a new base cost, which is the market value on 1 July, because she was treated as if she bought it on the 1st of July. Obviously, when she sells it, you'll use it then. So if she sells the Kruger rands, that will be the base cost. If she sells the boat, it's longer than 12 meters, that will be the base cost. If she sells the car, that will be the base cost, but it's personal use assets, so there will be nothing. And remember, the computer is permanently established in South Africa, so there's been no movement with that.